What a session we had there with Steve Polizzi and guest co-host Jordan De Jong, where we spoke about financial freedom and comparing commercial versus residential property. I don't know about you, but growing up for me, that was one of the reasons that got me so jazzed up about investing. It was that passion and that desire and that aspiration to reach some financial freedom. And in this session, that is exactly what we sort of looked at and had heaps of awesome insights and discussion around that. We started off with talking about what is happening in commercial property around the grounds. And we looked at not only what the hot spots versus not spots, but the hot assets versus the not so much assets as well. So that was an insightful and amazing session where we sort of talked about the specifics of different markets and even different sort of asset types, such as commercial, such as industrial, retail, office space, and some super interesting insights there as well. And then we got to the core sort of message, which is around financial freedom. Now, Jordan took us through a power-packed and fun session on a comparison of residential versus commercial, looking at what happens when you change the yield, what happens when you delay a purchase or two, or purchase a property or two more, and looking at what is going to get you to that financial freedom number and in a certain sort of period of time. That was a super visual and an interesting session. Part of the session, and I think if you need to tune into YouTube and check that out to sort of see what it actually looks like and what it maps out to. Then we were lucky enough, if that wasn't enough, we looked under the peak at some of under the covers of the deals that Steve has buying. We looked at not one, not two, but 3 deals that he sort of purchased recently and did a thorough due diligence on that. So it was very comprehensive and exciting. To top it off, put a cherry on the sundae of the financial freedom, we spoke about some of the nitty-gritty of syndicates and sort of the pros, the cons, the risks, and what you really need to be considering with that. Hey everyone, my name's Jeff Miles, and together with Joe Tucker, we created Oz Property Investors. It has over 70,000 property investors. We are the largest Facebook group in Australia because we get amazing guests, amazing insights, and this week is no exception with with Steve Polizzi, a special guest, Jordan De Jong, talking through the path to financial freedom using residential versus commercial property to give you the optimum outcome to achieve your goals. Drop us a comment what financial freedom means to you, like and subscribe, and we'll see you in there.
One of my friends mentioned a concept to me today, which was quite interesting. I never really considered it. It was like blue chip commercial property. And he was saying that generally the yields are quite low for blue chip commercial property. I never really thought about commercial property in that light, but what would an example of like a blue chip commercial property be, and what sort of yields could you expect?
Yeah, so that I get that all the time. People go, I want a blue chip property. It's like saying I want a blue chip residential. Like, is Mossman blue chip? Like, you're just basically saying you think it's a low risk region, but the commercial, it's like they're talking about like national tenant, like a Bunnings, McDonald's, Hungry Jack's, or just a logistics company that's national, that's back, thinking that means they're going to be safer. That actually doesn't mean they're safer. Like, yes, it means they may be likely to pay the rent, but it doesn't mean they're going to stay there long term. Like big companies can move quite easily as well. Again, case by case. If you're buying a McDonald's, they're not just going to move. They're not going, oh, business is doing great, let's just move. They don't. They open another store. So it's based on that. But if you're getting a lower yield for that security, so like medical, people go, medical's blue chip, I want that. And you start getting a 4% yield instead of a 6% yield. Similar to the office argument I made before. You're like, what was the purpose of you buying? Like, are we buying for capital growth? Are we buying for risk mitigating a vacancy? Or are we buying to build a passive income? And that's what we kind of said at the start of the podcast is you need to assess what you're actually buying for. And I've mentioned this on other podcasts, what you're trying to achieve, what time frame versus what you've got to work with. And then you kind of go from there. And then that'll guide you. There's no point me if I've got a retiree coming going, oh, I want a blue chip property for retirement because I want the low risk of vacancy, and we buy a 3% yielding one. Like, cool, let's go get residential. Let's go buy a duplex that gives us 6%, for instance.
So one of the key things with the key differences between residential and commercial is with the residential portfolio, I think we're buying 3 in like 5 years. Yeah. So between now and 2028, we were essentially finished our acquisition of our portfolio. We'd bought the 3 assets. With the commercial, our last purchase, because we do need the 30% deposit, finishes in 2031, I think it was. So it really does take the time to be able to get into the commercial asset portfolio. It's going to take a lot longer than it usually does. But the cool thing is with the passive income is we can really start to see this, like we're essentially positive from day one. And where we were negative, 40 grand or something for the residential portfolio, we're actually positive 10 now. So, we're not having that additional financial burden on the household of, do we not go on that holiday? Do we not go to private schooling and everything else like that? We actually got more income coming through. So financially at home, you're going to have that decision-making process impacted. The other really cool thing is we actually pretty much hit our passive income goal by 2046. We've got 240K worth of passive income coming through, and our target's around the 260 range. So we're pretty much bang on from where we need to be. So from a passive income, sorry, go, Jeff.
And that's even at 70% LVR with a 5.8. Well, I suppose the growth rate probably doesn't impact that just impacts the size of the portfolio.
The 70% will give you a better cash flow because you've obviously got less debt, but then there's less leverage to get into the next property or use the same amount of money to actually have a bigger portfolio. So there's a pro and a con of each one.
So the equity in the commercial asset at 5.8% growth rate is about 4 million. So it's about $1.1 million difference in the equity position between the two strategies together. But the other thing that we haven't considered is we've now got 22 years of this additional cash flow coming in that's going back into the savings pool. So what about the question of, after we pay tax on that income and it comes into our savings pool, is that $1.1 million equity difference worth the same amount of the additional passive income that comes through? Yeah. So we can compare that within the system. And so if we do that, we can, we've got a couple of different charts. Our yellow line is our residential portfolio. Our purple line is our commercial portfolio. So we can see that the residential portfolio gets to 11.8 over 30 years versus 9.3 from a growth perspective. Income, we get to a total of 328 versus 192. Debt levels are relatively the same. They're about 100K difference as we, continue to build out the portfolio. So that's quite good to note. But the real question is the cumulative position where we've got our equity position plus the after-tax passive income. And the interesting thing here is commercial is actually not much better, but essentially the same until 2046, which is when that goal retirement age. So if you went the commercial route, the combination of the equity plus passive income is 5.2 million. And the residential is 5.3 million. So it's only 100K difference. But the benefit of going commercial is you've actually got all that income coming through as you're building out the portfolio, and you don't have the financial strain of the negative 40 grand going out from your personal income. So to answer everyone's question, again, it comes down to your time horizon. If the time horizon is, this 2046 year period, they're actually quite similar. If the time horizon is 30 years, we can see that, yes, residential does outstrip. So we get to a combination of 11 million in residential.
Because we had a high equity growth, which Philippe's going to argue against it, but I suppose
we're going to dramatize it. But that's a really cool graph. Like Jordan said, you actually can end up being the same thing. And then it gives you options anyway. If you're residential, you can sell and realize some of that value and then shift it into a commercial, for instance. So it actually gives you options either way. But you guys know I'm an advocate for both, obviously. Free books, Ozprop.
So what's I want to ask, I don't know, do we want to do the combination? I think we're good.
No, we don't need to. The answer is for everyone, it's not one or the other. You don't go to one group and the other. You essentially build out your residential portfolio until you reach your borrowing capacity, which is generally 2 to 3 properties for most people. And then you move into the commercial sector where you can get those lease doc loans and different types of lending to help you continue to build out the portfolio without having to go into syndicates and joint ventures and everything else like that. You can continue to build it yourself. So the real answer is a combination of everything. It's not like one hard or the other.
what are the risks associated? I mean, we've talked about the risk of commercial, but just in a quick, very Cliff Notes manner, please. What are the risks with building that sort of portfolio in commercial?
The obvious one, which everyone talks about, is vacancy. And this is where if you don't know what you're doing and you buy a dud and it sits there vacant, like Jordan said, like, oh, you can still go on holidays and all that. You can't when it's vacant. It goes very, very negative, where there's less mistakes to be made in residential as long as you buy the fundamentals. But people always say, oh, commercial's high risk because if you buy those properties that have long vacancies, you're going to be financially ruined. We all know, like, investors, and even you, Jeff, who have bought dud residentials. They've bought like an off the plan or something, and then they go, "Oh, commercial's too high risk." Went and bought this off the plan that lost me $200,000, and it was like, well, so you still have to know what you're doing in either one. The work is just harder in commercial to make sure you're buying the right one. That's probably the biggest thing.
Yeah. Somebody asks, because we do have a session with Nick Wilcox, probably, what was that, maybe 9 months ago, maybe 12, who knows how long ago it was. But he really spoke to that. But do you want to give a really quick answer for this user on how it works for commercial?
Yep. All right. So full doc, exactly the same. They've still got the shading criteria. They still add extra interest rates on, things like that. You can get 15, 20, 25, 30-year loans. Personal circumstances come into play because it's full doc. They're looking at your whole portfolio, doing all that. Where this question is probably going to lead is you can go into lease doc with commercial, and that's based on the strength of the lease. And that's where, when Jordan was saying, when you run into serviceability problems with residential, that's when you might go into commercial lease doc loans because you can keep moving. But in saying that, you can still get a full doc loan that makes sense, because when banks are looking at residential portfolio and commercial, they do their shading. So they take 80% of the rent, they slap on their 1.2 to 1.3%, for instance, extra interest rates. They do principal and interest. You've got a negatively geared residential. It looks really negative in their eyes. You've got a slightly positively geared commercial. It only goes to slightly negative. So it's not going to add to your serviceability. It's just not going to take away as much as a residential. So you still might be able to push the envelope a little bit with commercial and full doc lending.
We're gonna talk. I've been heckled about syndicates, chat. So let's talk to it, because there was even a deal that you were saying. Is that deal too long to talk through? Or what are you, that one you had over WA?
Okay, I'll give. How long we got? We got about 20 minutes. All right, I'll give a quick run through.
We can talk longer, but if you want to finish up an hour and a half, up to you, man.
Yeah. All right. So syndicates, people think they kind of encapsulate all types of properties where lots of investors are going in. There's two: syndicates, and then there's joint ventures with lots of other investors. So a syndicate is normally like a financial fund that you go into. They normally got to be around 20 mil, and you got to put in a certain amount of money into it. Normally have to be a sophisticated investor, which means you earn more than 200. I think it went up to 250 actually recently. Get a letter from your accountant doing that. And they're normally leveraged at 50%. The benefit of this is you actually get to buy a really big asset. Like you can buy like your Westfields or a whole office tower, or even a few properties together that you normally couldn't afford yourself. So where you want to chuck in like 200 grand, you can get a big asset that gives you a return. Normally it's pretty good. It's 5 to 7%, depending on kind of what you buy. The negative though is you've got no control over that asset. So it's kind of just like buying shares. You can't do anything with it. And then you're only leveraging 50%. And as Jordan just showed, there's a huge difference when you leverage 90% for residential, 70%. Now we're shifting the dial down to 50%. So you're actually going to miss out on like the capital growth leverage part of it, as well as the cash flow. And I'm not saying they're bad. They're really good if you've got a lot of money and you're in the retirement phase and you don't want to leverage up, or you don't want to buy a single asset and take on that risk because you buy a shopping center with 20 tenants in it. Cool. It's very unlikely, unless you buy in a really bad area, they're going to lose 20 tenants. So it is probably what I'd say lower risk, but you're losing out on leverage, which is the whole purpose of investing. You can get some really good returns in share funds that aren't property as well. So you then have to start comparing those, and they can be leveraged as well. So they're the actual official syndicates. A lot of people also will get, it's normally family and friends like, oh, can we pile our money together and buy a bigger asset? We'll get a better, lower risk asset. Yes, potentially, but why are you doing it anyway? I can tell you joint ventures go wrong more times than they go right. And that's because everyone's circumstances change. Like Jordan, I know in the past was looking at commercial, and then he's done a lifestyle change to the Gold Coast. People get married, kids, they move away, they move overseas like I've done. There's death in the family. There's always something. If you know anyone over a 5-10 year period that hasn't had some major life changes for the people around them, it's pretty hard. So like you need to be airtight with the legalities of it. And even like people go, I'll do it with my family, it's safer. It's probably not. It's probably worse with family because there's emotion into it and you can't get away with it.
Imagine going on the Christmas lunch and grabbing that turkey and having lost somebody's 200K. Like, geez, how that conversation's going to go pretty well, isn't it?
Yeah, exactly right. But then sometimes it does make sense. And I think this is what we're going to show. I've brought up a few deals that we've done recently. One of them, we actually put multiple clients together because they wanted that. And we got all the legalities kind of tied up. So there's like 5 and 10 year and 15 year periods where if anything goes wrong, that's what to do. But we bought a whole shopping center for $8.5 million.
So nice. I want to know about I want to know about capital growth. Like I'm going to focus on that point because like if I'm buying into the syndicate, does then who decides what happens with the capital growth? And is there an overarching committee that decides that? Like how do you decide what happens with that growth? And if you sell or I suppose you sell your component of the syndicate. Is that the way it works? I imagine
for the syndicates, yes, they've got like the exit clauses. Sometimes they actually have a sell period, so they actually are just doing it for 5 or 10 years, and no matter what, they sell it, and then they distribute the funds to the investors. Other times you can buy and sell out. It depends what it is, and this is the fun part with commercial. Like it does follow the financial services, but basically anything goes. You can kind of make a contract for anything, which is the best part of commercial, and it's also the worst part. Same thing with leases. You can write whatever you want in a lease. Couple little things about like retail leasing act about like can't pass on land tax and property management, things like that. But outside of that, it's a private enterprise. Go nuts. The biggest thing that probably changes, and this is when people ask like, should I buy a small one, 2 smaller ones, 1 bigger one? As you start shifting up in price, you start looking at more versatility. So when you go like sub 2 mil, you're pretty locked into like a body corporate kind of warehouse or retail shop, or a freestanding one on the outskirts of a capital city or a regional town. But as you start shifting up from 2 million, you look at more freestanding, which creates more value add opportunities because you own the building. So you can subdivide the tenancies, you can put solar panel on, advertising. You've got a bit more control of it. But then you also look at multi-tenancy. So you can actually start buying like that one I just showed you, the Canberra one, could split that into two tenants potentially if you talk to a town planner. So you've got that option as well. Or you could actually buy one, like buy a 3 warehouse one. So get something that's got 3 different tenants and they're smaller tenants. So you start looking at more versatility. And then as Jordan says, you start looking at blue chip tenants. You start looking at the McDonald's and the Bunnings. We're looking at a Hungry Jack's at the moment in Bendigo on a 6% net yield, which I think is a good buy. Wow. So stuff like that, you start looking at that, but you need $3-4 million that way. So and they can still be a good asset. Like when we did the game plans and we got to the end of the resi portfolio, you might actually decide to sell a couple of the resis, buy that Hungry Jack's on that 7-year lease at 6%, and really beef up to get to your goal of what was it, 200 grand, I think from memory. Get to that 200 grand. So just shifting a property to get where you want to be.